Welcome back to our channel. Today, we're diving deep into one of the most significant events in recent history, the 2008 stock market crash. We'll take you on a journey through the causes and consequences of the 2008 stock market crash and uncover the truth behind the collapse of the housing market, the rise of subprime mortgages, and the role of Wall Street in the events leading up to the crash. But that's not all. We'll also examine the impact of the 2008 stock market crash on the global economy and the lives of millions of people around the world. We'll explore the government's response, the lessons learned, and the changes that have been put in place to prevent another financial crisis like 2008 stock market crash from happening. This is a must-watch for anyone interested in understanding the complex web of events that led to the 2008 stock market crash and its lasting impact on the world. So, sit back, relax, and get ready for an informative and exciting journey through one of the most important events in recent history. Don't forget to hit the subscribe button and turn on the notification bell to never miss an update from our channel. Subprime mortgages are home loans that are made to borrowers with poor credit. These borrowers typically have credit scores that fall below the prime lending threshold and may not qualify for traditional home loans. Subprime mortgages often have higher interest rates than prime mortgages and may come with additional fees. They are considered higher risk for lenders and borrowers alike. During the mid-2000s, subprime mortgages became increasingly popular as a way for many people to buy homes, particularly those who would not have been able to afford the homes otherwise. Lenders relaxed their lending standards and began offering these mortgages to more and more borrowers, including those who had poor credit or high levels of debt. This led to a housing market bubble, as housing prices soared and many people were able to buy homes they couldn't afford. The bubble eventually burst, and when homeowners began defaulting on their subprime mortgages, it led to a financial crisis that spread throughout the global economy. Subprime mortgages played a significant role in the 2008 stock market crash, as the default on these mortgages caused the housing market to crash and banks and financial institutions that had invested in these mortgages found themselves in financial trouble. The crisis led to a domino effect, causing many banks and other financial companies to go bankrupt and leading to a credit crisis. Lack of regulation refers to the absence of proper oversight and rules in a particular industry or sector. In the context of the 2008 stock market crash, lack of regulation refers to the insufficient oversight of the financial industry by government regulators. During the early 2000s, the financial sector was experiencing rapid growth, and many new financial products and practices were emerging. However, government regulators did not have the necessary tools or resources to keep pace with these changes and failed to properly oversee the industry. As a result, many risky practices went unchecked, including the issuance of subprime mortgages and the use of complex financial instruments like credit default swaps. Credit default swaps, CDS, are a type of financial instrument that are used to transfer the credit risk of a particular asset from one party to another. Essentially, a CDS is a contract between two parties where one party, the buyer, pays a premium to the other party, the seller, in exchange for protection against the default or credit loss on a specific asset. The most common asset that CDS are used on are bonds, but they can also be used on loans, mortgages, and other financial assets. During the early 2000s, CDSs became increasingly popular as a way for banks and financial institutions to transfer the risk of their investments to others. However, the widespread use of these instruments created a complex web of financial interdependencies that made it difficult to understand or manage the risks involved. Wall Street, the financial district in New York City, played a significant role in the events that led to the 2008 stock market crash. Banks and financial institutions on Wall Street had invested heavily in subprime mortgages and other risky assets. They also packaged and sold these assets in the form of securities to investors around the world. The lack of oversight and regulation in the financial industry allowed these practices to continue unchecked. When the housing market collapsed, many of these institutions found themselves in financial trouble and were forced to write down billions of dollars in bad loans. This led to a domino effect, causing many banks and other financial companies to go bankrupt and leading to a credit crisis. This credit crisis then spread to other sectors and led to the 2008 stock market crash. Wall Street firms also used complex financial instruments like credit default swaps, CDS, which further increased the interconnections between financial institutions, making it harder to assess risk and contributing to the crash. The culture on Wall Street prior to the crash was heavily focused on short-term profits, which encouraged risky behavior and a disregard for long-term stability. In summary, the role of Wall Street in the 2008 stock market crash was significant as the financial institutions based their invested heavily in risky assets, used complex financial instruments, and had a culture focused on short-term profits, all of which contributed to the crash. A housing market bubble refers to a situation where the prices of homes in a particular area or region rise rapidly, often to levels that are not sustainable. This can happen when there is an influx of buyers, a shortage of housing, or a combination of both. Bubbles can also be fueled by speculation, where people buy homes not to live in them but to resell them at a higher price. In the lead-up to the crash, there was a housing market bubble in the United States. This was driven by a number of factors, including low interest rates, lax lending standards, and the widespread availability of subprime mortgages. These mortgages were given to borrowers with poor credit, and many of them had adjustable interest rates that would increase after a few years. This meant that many homeowners would eventually be unable to afford their monthly payments, and they would default on their loans. As housing prices rose, many people were able to buy homes they couldn't afford, and this led to a speculative boom in the housing market. However, as interest rates began to rise, many homeowners found themselves unable to make their mortgage payments. This led to a large number of foreclosures and a decline in housing prices. As housing prices fell, many homeowners found themselves owing more on their mortgages than their homes were worth. This, combined with the large number of foreclosures, led to the collapse of the housing market, which was the trigger for the crash. And that's it for our video on the 2008 stock market crash's causes. In the next part, we will see the financial crisis that happened because of this crash.